We are live, but I'm not. Okay, here we go. I have, a number of things to talk about today, and today's show. What was it titled? It was titled. See, I'm skipping the countdown today because I was a little bit behind. But very good. So we're going to talk about today the process of getting into a zero DTE trade. Now I talked about last time why the first part of the day, early part of the day, is most advantageous, and how we take advantage of volatility. Today, I'm going to talk about all of the things that come together for us as traders and how we actually get into a trade, and I'll try to demonstrate that as best I can. So I'm focusing on a certain strategy that we trade called the zero DTE tactical. Now this particular trade has been incredibly good to me. I have traded it for many years, thousands and thousands of trades. I have a ton of empirical evidence on how it worked. But more importantly, where I originally got the idea from the trade was back in the late 90s, actually, when I was working as chief architect for Sun Microsystems, and I was working down on the American Exchange. We were building out systems for them, and I got a chance to go down there and talk to traders. And they were trading an out-of-the-money butterfly, and they used this 10% debit rule and so forth. Anyways, that's where I originally got the idea. And since then, it has changed dramatically. I mean, after thousands and thousands of trades over the decades, I have come to realize that their idea of pushing it way out of the money was brilliant, but they didn't go far enough. And the way I found that out was after studying the works of Nassim Taleb, who many of you know wrote The Black Swan, which is an allegory about how markets and humans and everything periodically gets disrupted. And it's only after the fact that we can look back and say, oh, that was completely obvious. But up until that point, nobody had a clue. It just comes on. Anyways, that work, along with his work on volatility and randomness, and then his involvement with the Universa Fund and them taking this idea of tail risk to a whole different level, what they call fat tail, was implemented in a fund called the Universa Fund. I think it had a couple $100 billion in it, or something like that. But it famously made over 4,000% during the COVID crisis. And while Nassim Taleb was a big believer in fractals, because he was a study of Benoit Mandelbrot, who brought us fractal geometry, he was also of the mind that this particular strategy needed to be geared towards only long dated or unknown existential events that would happen, like big market crashes. And there was good reason for that, because with that much money, it's very difficult to trade this thing on a frequent basis. However, it's not so difficult for individuals to trade it, individual traders, at various fractals along the way. So he stuck with the biggest fractal, but he recognized that you could take this same concept that makes 4,000% in a very large fund and bring it down to just about any size or time frame that you want. And so what the zero DTE trade is, the way I originally found it was through what the traders on the American Exchange were doing, and they knew nothing of at the time. Well, maybe they did, but I don't believe they really knew about Nassim Taleb or Benoit Mandelbrot. But that's what I look at the market and all the traders there as being kind of evolution. You know, they come to find trades after doing things millions and millions and millions of times, and then their strategies evolve over time. And they came to this particular strategy. It had particular great performance. So that's how they came to it. And then, of course, Nassim Taleb is on the other side. He's an academic and a philosopher, and his idea of disruption in markets was well noted. In fact, his series of books on Black Swan, Fooled by Randomness, Anti-Fragile, and all of his books, and Skin in the Game, are among the most widely read books on trading. Now, the interesting thing is that if you read the books, you'll realize that there's very little there about trading. They are allegories that talk about the philosophy and the concepts behind it. All right, so I'm getting a little off track, but let's go with what the 0 DTE trade is. It's an out-of-the-money butterfly, and it's both a directional trade, and that's what we'll be talking about first, but also a trade that takes advantage of premium decay, because that's why it's done on the 0 day. So it's both premium collection and directional. The very first thing that you need to do when you're setting up such a trade is, well, first of all, you need to know what you're trading before you even trade it. And let's just face it, if you don't know the trend, you don't have a game plan. You're just gambling. Now, before the bell, I want to know, am I hunting a pullback or in a bull trend, or a pull up in a bear trend, or bracing for an impulsive open? That one decision will shape everything I do in that day trade. All right, so that's the setup. So that's the very first thing. But I also know that I want to put on a position that has extreme asymmetry, because there's convexity there. Convexity and asymmetry go hand in hand. That's where I find the cheapest possible strategy that will give me the best possible return. And that has a whole range of different benefits to it, which I've talked about all last week. And I'll be going into it forever because it's so unbelievably poignant. But the very first thing you want to know is you want to know what direction the market's going in. And in the big picture, you can't really predict which way the market's going before the market opens. A lot of people think that you can do some sort of technical analysis, mumbo jumbo, and you can tell which way it's going. Now, if that were true, then everybody would be doing that, and they'd all pick the direction correctly, and we'd all be billionaires. But it isn't. And the market is really kind of a random shot, whether it's going to go up or down on any given day, even if it's in the direction of a trend. So that's an important point. If you go back and you take a look at a bullish or a bearish trending market and then count up the up days and the down days, and I'm talking about a substantial trend. I mean, you can pick any segment and say, oh, there were more bull days than bear days, and then, yeah. But I'm talking about a significant number of trades. You'll find that the number of days that go up or down are about equal. There is a slight advantage on the bullish side, but only slight. And to drive this point home, we could take a look at things like, let's see. I've got to bring this up here. This is the perfect illustration, so we'll take a look at this. I can't find. Oh, there it is. That's not what I want. I want this. All right. So what you're looking at here is the daily distribution of prices. I don't know, that's not a great one. I have a much better picture that's way prettier, and we'll take a look at that. Oh yeah, I like that. That's much better. We'll look at this one, or should we look at this one? Oh yeah, that's good. Yeah, I get all bent out of shape over graphs. And there we go. Perfect. So this is a distribution of daily returns on the S&P 500 since the year 2000. And so what I did was I color-coded it based on the number of standard deviations out. Yellow is less than or equal to 1 standard deviation. Orange is between 1 and 2 standard deviations. Red between 2 and 3. And then purple more than 3. Now, here's the interesting thing that proves my point about trends. Now, this is all price movements, all trends, everything combined. And you'll see that there is an equal distribution of prices above the market as there are below the market. Almost exactly the same. If you really do a very close analysis, you'll find that the bull side has about a 1% advantage, but it's minimal, and you would never see that on a daily basis. So that proves my point that even in a trend, the direction of that trend, if you count up the days, they'll be about equal. And if you were to do this month after month, year after year, decade after decade, you would find the same thing. So that's the way it works. So that's an important point. But there is a reason why we trade with the direction of the trend. And the reason why we trade with the direction of the trend, as you know, many of you heard, the trend is your friend, is that those moves, what makes a trend go in one direction or the other, is that the average move in the direction of the trend tends to be of greater magnitude than the counter trend moves. So think about that. If we're directional traders, we want to trade with the trend, because that means if we're trading with the trend, we're going to more likely hit upon those larger moves that are in the direction of the trend. So that's why we have to do that. It doesn't mean that we know that that's what it's going to do. It just doesn't. So that's the very first step. All right. I'm going to go through a presentation, and I think probably the best thing to do is to show you the presentation, and I'll walk you through it. And yeah, I think that's the best way to go. And then we'll look at charts and other things, and then talk about how we get into trades and under what conditions and all of that. But I don't want that. I want this. All right. So here's establishing. First step. First, I'm going to give you the 5 steps. We have to establish a market bias. We have to map a structural battlefield. And what that means is that we have to map out volume profile, because we're looking for the structure of the market. And you find that with volume profile. We need a consistent time frame. Well, let's just say that I'm going to talk about the time frame consistency and how that is more advantageous. And in some cases, there you can say you want some flexibility, but we'll talk about that in a bit. And what patterns do we use to figure out whether or not something is going to justify an entry? You know, there will be an entry event. And so what patterns are we looking for? And then we'll look at how we prepare for that entry event and plan for it. You know, in trading, if you already know what are the 2, 3, 4, 5 different possible things that could happen upon your entry, or at least you can reasonably map them out based on structure, then you can have your trades already set up, ready to go, and you will minimize human fumbling and errors. So that's what we're going to talk about there. All right. So let's talk about this. Determine the predominant trend. We already talked about that. Determine, you know, what's bullish or bearish. Define what that means for the day. And is it bullish? Is it looking for or hunting a pullback and a reversal up? Or is it bearish and we hunting a pull up and a reversal down? So let's take a look at a chart and see what I'm talking about there. So what we'll do is we'll go down to trading view. And yeah, this is a good example. Let's say that, okay, we're trending up. I'm sure you would agree. Well, let's look at one that I've already marked up here. All right, here's a good one right here. We'll get rid of all the tools and everything else. Hide everything. All right. So here's a long trending market, and this is a day view. So if I zoom in on any of these candles, you'll see that there are other smaller trends within the trend. But we can clearly see that the market, when it's moving up, is moving in kind of waves. It moves up, pulls back, moves up, pulls back, moves up, pulls back, moves up, on and on, all the way up here. This one is just a tiny pullback, etc. That's what it's doing. That's the way of the market. Now, if I were to ask you if I wanted to join this trend and I'm somewhere down here, where's the best place to join it? Everybody knows this. Everybody knows that it's on the pullback. Well, it's exactly the same thing when you're moving down, when there's a downtrend. So in a downtrend, you move up, move down, move up, pull back, pull up, move down, pull up, move down, pull up, etc. And on these, we're looking to wait for this pull up, and then the reversal happens, and that's where we enter, because that's going to give us our best opportunity for a long run, or to maximize the move, right? So that's what we're looking for. That's a big picture. This is a daily chart. But when we're trading 0DTE, we're not trading on the daily chart. We're trading probably on a 5-minute chart. And so we know, for instance, we're trading like this, and we know that there's a bullish trend on. Let's just say that that's our bias. We might go to the daily chart and look at that and have some technique that tells us whether this is a bullish or bearish trend. Now, there are a number of ways that you can do that. You can look at a moving average and set up your moving average, and you can say, okay, depending on the slope of the moving average, that is it sloping up or sloping down? And on this particular moving average, it changes color when it changes slope. You could use that as your consideration, whether it's a bullish or a bearish trend. The other way you could do it is you could look at whether price is above the moving average or below the moving average. And so if it's above the moving average and it closes above, then you can say that's bullish or bearish. So that's a very simple way to do it. And there's many other ways to do it, but I'm just going to take this. Whatever you use, just make sure you do it consistently. So in this particular case, we have both conditions, and it's hard to see, but it is both changed color to a upward slope and it's above. So if that's your method, then, for instance, you want it to be both sloping and above, and that's how you go bullish. Now, what happens if it's sloping and below? Then I guess you can flip a coin, right? That would be one possible scenario, considering that it's a 50-50 shot. So we have to determine trend, because what that's going to do is tell us whether or not we're going to put on a call fly or a put fly. A call fly will go above the market, a put fly will go below the market. That's the very first step in all of this. All right. So let's take this as an example. These, and yesterday, I think it was yesterday, I'm sorry, Friday, I talked about the best time to trade, why trading in the morning is the best time. And so I have marked off on my 5-minute chart where the morning is. And so here's the morning, these two vertical lines, and then also over here. This was Friday morning on the 8th, and then this was this morning. Now, if it's a trending market and it's trending up, then I want to get in on a pullback. And one of the most opportune times to do that is in the morning when there's the maximum amount of volatility. So in this particular case, I'm waiting for, something like this. All right? When it pulls back, then I enter in a bullish market. Now today we're still in a bullish market, but it happened to reverse and it's ending up bearish. That happens. Like I said, even though you're in a bullish market and you have your trend methodology, it can still turn around on you. So there are, under certain circumstances, where we might choose to go the other way, but for the most part, we're looking at taking very small risk and looking to really score big. So if we're wrong, we're wrong. We're wrong small. If we're right, then we're right big. And that's a 50-50 shot. So if 50% of the time we're wrong, then it's just a small loss. If 50% of the time we're right, it's anywhere from small, medium, or huge win. So you can see how the odds are in our favor. So that's the first step in what we're doing here. And from a trading point of view, let's see, we'll go to Thinkorswim. So let's suppose that we have such a trade, and this isn't such a trade, but let's say it's above the market. I'll change it here so it's above the market. 500, 450, 550. All right. So we'll say that we have a position, and we're above the market. We enter here. We're expecting to price go towards it. Right? So that's the whole idea. So price is moving towards our position. It pulls back. We enter the trade. It pulls back, hits a structural level, and then we get into the trade. Now, how do we figure out structural level? So those are the most basic requirements. We choose a direction. We map out our structure. The market opens. It pulls back to a structural level. We take the trade, and we take the trade based on our premise that it has to have asymmetry. So that means putting it way out of the market, and it has pricing that would give us the kind of convexity that we're looking for. And in most cases, we're talking about minimum a 1 to 10 risk to reward ratio. So in the old days, back when I was on the American Exchange, they used to say never pay more than 10% of the debit. The debit should never be more than 10% of the width. So if the width is 50, you never pay more than $5. In my case, I'm looking for something much more extreme. And so I would typically put something on for maybe half of that, $2.50 or even less. And that's because there's great advantage to doing that. And I'll talk about that in future episodes. So that's our basic setup. And so let's go on to the next point. We got to go to there. There we are. All right. So we're looking for a pull back or a pull up if we're bearish. All right. So we're deciding all this, by the way, in the pre-market. Here are the things that we do in the pre-market. We map out our structure. We determine the directional bias. We look at the VIX. That tells us what's the level of the VIX and how wide we want to go. And I'll show you that right now. That's another component. Trading view. And this is like a playbook for us. We have the VIX. And I have it all mapped out, the different levels of the VIX. I even have names for the different levels. We call these volatility regimes. I've gone over this before. Zombieland is below 17. Goldilocks is between 17 and 32. And above 32 is called chaos. And I showed in a previous show exactly why we choose these different widths based on the level of premium decay and the rate of decay. So that's, I believe, episode 2. So if you're interested in that, go to episode 2. That's a great lesson talking about how volatility affects the rate of premium decay, and then how that affects the pricing of your strategies. So we figured that all out, and so we know that when there's low volatility, we are going narrower, and when there's high volatility, we're going wider. So now we know direction, we know width, right, and we know structure. So now all I have to do is wait for the market to open and wait for that pull back or pull up, and when that happens, and we have determined that there is a reversal at one of those structural levels, then we enter the trade. So we're not quite there yet because we still have a couple of problems. How do you know if there's going to be a reversal? That's a good question, Ernie. So we want to know, is there going to be a reversal? And so that's the next step. And that really comes down to time frame, consistency, and flexibility. All right. So the setup, here I'm going to read here, is only as good as the lens you view it through. Your anchor time frame gives you rhythm and confidence. But when the market speeds up or slows down, you'd better know how and when to zoom in or out, or you'll miss the turn entirely. So that's the first point that's very important. You need to figure out what's your favorite time frame. And, we're doing a day trade. What gives you the most granularity and the ease of looking? If you're getting too deep into the weeds and you're trying to figure out where every turn is on a 1-minute chart, it's going to get noisy. I've found that a 5-minute time frame seems to work well. And so we focus on the 5-minute time frame. And what I'm saying here is that time frame consistency is really important because, and as I'm saying here, 5-minute bars are really 90% of the setups. There are occasionally when we're working on a structural level, we're trying to figure out, is it going to bounce off there, right? We don't know. But then there are patterns that you see that are just so glaringly obvious, like a tweezers pattern, which is where price comes down very sharply and then moves very up sharply in a move, and it looks like a pair of tweezers. And that's a no-brainer. We would then take the trade right then. You've also seen things like a bullish hammer or a piercing cloud. I mean, there's probably about 15 or 20 different patterns, each one with their own probability of success. And you should become familiar with those. And through experience, you'll start seeing which patterns seem to work the best for you. And by sticking to a time frame, you'll have consistency in that setup. So the goal here is pattern recognition without overfitting or missing key details. So we've got the bias, the battlefield, and the right lens. The next step is knowing exactly what to look for and when price reaches our level. The patterns and signals that confirm it's time to strike. So we're looking for that reversal off that structural level. Now, I'm not going to go into great detail about how we create the volume profile structure. We're going to leave that to another show, and I'll show you how to actually map out structural levels, and I'm going to show you why it's so important. So the next step we're going to go into is pattern and divergence confirmation. So I've already talked about this a little bit, but structure tells you where to look, but patterns and divergences tell you when to fire. And so this is the important part. It's coming down, it's hitting that structural level. Is it going to stick there and then reverse? And is that the place where I want to fire off my trade? Or is it, or maybe it will, and it looks good, and then it keeps on going against you, and then you have to look for the next one. But you'll find that there are certain patterns that will give you a high degree of confidence, and then you just act. Now, we trade small, so if we're wrong, we can always add on to the next level if it continues to go down. But there may be, an acceleration of price, or it will really be based on what the volume profile structure looks like. So if it misses, let's say on the bottom of a node, that should produce pretty good and solid support and just zaps right through there into a big low volume node, which has much lower liquidity, we might give it some room to breathe and let it go, right? And so because of that condition. So having that situational awareness is very important. But once we have a green light, the trade isn't over. It's just begun. Now we need to think 3 moves ahead. Now this is another very important point. Getting into a trade is only one step. Actually, getting into a trade is the easiest part because we've already determined all of this. I'm going to bring back the big head here. Yeah, so getting into a trade, most people think that, hey, give me signals so I can get into a trade and I'll make bank, right? That's not true at all. Getting into any kind of trade is usually the easiest part. It's the profit taking that is the hardest part. And we're going to cover that later on, but not in this episode. But I'm going to tell you how you can set up and plan for your profit taking once you've gotten into a trade. And it's very important. I want to know ahead of time what are my possible scenarios, or at least what I think are possible. And I want to map those out before I actually get into that trade. And so I'll look at the different levels and I'll say, man, if it bounces off here and I get into this trade, what could happen after that? Assuming that it's going to reverse. Now, as it reverses, there's a number of other structural elements that you're going to come into play with. And any number of things could happen. It could, just do a stair step up. It could hit it and then reverse. It could, you want to plan out what you think are the bullish case, the neutral case, and then the bearish case. And in each one of those cases, you want to conjure up, well, what will your response be to each one of those things? Now, of course, the most desired one is the bullish case, where it goes in the direction of your trend and you're all set there. It's going towards your fly. Then you go through profit management, and we'll talk about that in another episode. The others, you want to be able to manage those and see whether or not it makes sense to either add on to the trade or just let that trade wither. You might think, well, why would I want to make the trade wither? And I'm going to tell you through experience that there have been many times where I've felt like, oh, the trade's going against me, and it's starting to go down, so I'm just going to cut my losses and get out. In this type of strategy, you don't have to do that. And the reason why is that you're already taking a defined risk, and it's very, very small. You're defining that risk because you know that there are some cases where a market can return and go right back up. And I've seen that happen many, many times. Had I taken the trade off, then I would be out that money. But because it reversed, I would have been out the fact that it reversed and made a lot of money. But if I take it off, I'm really not out much more than I have already assigned or signed up for losing in the first place. So there's really not a lot of reason to do it. And that's one of the real beauties of trading asymmetrically. You don't have to take these losses. You can allow them to go to zero. In fact, if you look at my trade log, you'll see that all of my losses, almost all of them, go to 100% loss. Now, there's a rare occasion where it might go against me, and then very late in the day, it moves up just enough to cover my original entry. I might take it there before it has gone into full profit, right? So that's sort of an edge case, but that happens every once in a while. But I've seen it go against me and then come right back up and be a big winner. Imagine that you're in a trade, you've spent $100 for it, and you have $5,000 potential profit. It goes against you, and you get out, and you saved yourself $25. You get out with a $75 loss, and then it turns around and turns into a $1,000 or $2,000 winner. Wouldn't you feel like you have egg on your face? Of course you would. So again, that's one of the reasons why we trade this way, so that we don't have to really manage risk. Managing risk is done ahead of time. It is done in the setup of the trade itself. And again, that's the beauty of this strategy, that I never have to manage risk. Instead, I'm doing something that most people wish, I guess you could call it a high quality problem, that most people wish they were doing more often, is just managing the profit. And typically the profit is multiples of the risk. See, that's the thing about this type of trading, where most of you are all, ecstatic when you're making 25% or 50% return. In our books, 25 or 50% return would be so small. A medium-sized return is 300, 400, 500%. A good-sized return is 900, 1,500, 2,000%. So that's the difference. And when we go the other way, when it's a loss, we're talking about tiny, tiny little losses. Most of my positions that I put on are not much more than 0.3% of my total trading capital. So I can have multiple losses in a row and still never really feel it. And sometimes my trades are even smaller than that. And that's because we have this extreme asymmetry. Now, it's true that we're not winning as often, but we don't have to win as often. The benefit is that we're not getting big drawdowns. We don't have our equity going all over the place. Instead, it's either going sideways or up, sideways or up, sideways or up. That's what we want to do. I haven't checked to see if we have any comments. Let me check that just for a second here. Nope, no comments. I guess you're all enraptured in the explanation here. I'm glad to see that. But if you have comments, please put them in there, and I'll address them. So, and if you like the presentation so far, please give it a thumbs up. Really appreciate that. All right. So our next step, let's see, we talk about core price patterns, tweezers, hammers, engulfing, long wicks. Those are all good price patterns. A divergence. If you're using a divergence indicator, we have our own divergence indicator that I built, and it gives us a clue when price is likely to reverse through the use of divergences. And that's a whole separate matter. I think I'll probably do a whole episode just on divergences. But we use divergences along with our chart patterns. And the divergence, when we do use divergences, we're trying to stack everything in our favor. So we see a structural level, price comes down to it. It looks like it's bouncing off of it. Is it exhibiting a pattern that we think has good chance of reversing? And is there a divergence there, or the semblance of a divergence? And through our indicator, we can tell when that happens. And essentially what happens in a divergence, particularly from a statistical point of view, we're looking at what is essentially, primarily, the linear regression slope of a series of numbers. And each series of numbers will change the slope. It's either pointing down, pointing up, this way or that way, but it doesn't necessarily go along with the actual price direction. And when we have a divergence where the slope is pointing up but price is going down, that's a divergence. And our indicator will flash a color and say, hey, you got a divergence here. And then it's right on that structural level. And at the same time, you see a chart pattern that looks like high conviction. That's a good time to get into the trade. And like I said, if you're wrong, you can be wrong small. You're wrong, and maybe it continues, maybe it starts to divert in reverse and go up in your direction, but then starts drifting down. That's why we trade super small in the beginning. It leaves us room to add to our trade. And I'll never add much more than one additional trade, and I will never go above my max profits or my max position size. For the most part, that's a little under 1%, probably around 0.6%. So if I get in for the first trade at 0.3% of my total trading capital, and I have to add another one, I'm going to make sure that that next trade doesn't exceed my max position size, which is 0.6%. And by doing that and sticking to that kind of discipline, I'm going to totally control my drawdowns. My volatility of returns are going to be super tight, and I'm going to have a great Sharpe ratio. The Sharpe ratio is the amount of profit I make per unit of risk. And so I'm trying to maximize that profit for as little risk as I possibly can. That's what's going to keep me moving up, and it's also what is going to keep me on the track to compounding. And compounding, that is your ultimate goal. That's where you want to be. Compounding means that you're doing this, and then this, and then this, and then that. And if you're drawing down, you are defeating compounding. This strategy, this way of trading, defeats what defeats compounding. In fact, it encourages compounding. All right, looks like we might have a couple of comments. When is the PDT rule changing to $2,000? That's a really good question, Nate. So Nate is asking that. We all heard about it. I have no idea. You know, the SEC and all the rest, I'm sure they're working on it and they're getting a lot of pressure to do it. I hope it happens sooner than later, but I really don't know. You know, Thinkorswim has also been talking about trading in aftermarket hours or around the clock with the SPX, the NDX, and a bunch of ETFs. And I haven't seen much going on there as well. Maybe they've done it on some ETFs. Some of you might know. Let me know. But lots of promises. I'd like to see action. All right. Julia asks, "Hi Ernie, I'm new here. Which delta do you choose for your trades, or is that irrelevant?" Totally irrelevant. So when someone's speaking delta, they want to know the delta of a particular spread, and they want to know, you know, how far out is it going. So a lot of people that are high win rate oriented traders want to choose a low delta, somewhere around 5 or 10 or 15. For us, I would assume that our deltas, I don't know. I've never looked at it. I've never really looked at it. We're looking at a completely different trigger mechanism, and that is the convex level. The convex level is that level where the price of your strategy, as you're pushing it further and further out, the price starts going down, 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 right? Maybe at a steady rate. And then all of a sudden there's a level where it might be reducing by, say, 10%, 10, 10, 10. Then all of a sudden it drops off a cliff and it's reducing by, say, 30 or 40%. That's the convex level. That's a rapid change in the rate of the pricing. That's the point where the market has decided they've lost interest in that. That is the type of trade that we want. That is also very closely aligned with the expected move. Most people aren't willing to trade outside the expected move. Why? Because they think that the expected move is somehow sacrosanct, that it is telling them where they're going to be making money. Actually, the expected move is telling you where you're going to pay the most to make some money. Let me put that again. Where you're going to pay the most, take the most risk to make a minimal amount of money. That's what expected move does. Once you go beyond it, it's telling you exactly the opposite, where you're going to pay the least to make the most money. So I'll show you a chart that's really impactful here. And this might drive the point home. Let's see if I can bring it up. I have to do a search for it, so just give me a second here. Expected move. Yes, that's it. That's not what I wanted. I want this. All right. So this is a plot of the expected move, and it is actually the this blue dashed line. So over the past 3 years. And it will look very similar if we just go back years and years. And the green and red lines going up and down is the size of the move, the actual move. The blue dashed line is what the market said the expected move. Expected move will be shown in most of your trading platforms, and it will show you exactly how much the market is pricing in for an expected move. And that's where that blue line is. In the green area is where the market has never reached above the expected move. Above that, you'll see that the expected move, about 20% of the time, makes a move that's 1 standard deviation above the expected move. That's a monumental move. And those are the moves that move us deep into our strategies and into our profit tents. 20% of the time. It's also, over that blue line, is the area where the cost of our trade goes dramatically down. So you have some asymmetry here. Below that line in the green, it costs you way more to be in a trade, way more risk, and you're taking super small profits. Above that line, you're paying way less and getting dramatically larger profits. Right? Now, there are quiet times, for sure. But even then, there are still opportunities above that line. So that's where we play. Hopefully that makes sense. We have a couple more questions. Diego. We are the one placing the pennies in front of the steamroller, and we are driving it. Right. I like that. So, yeah, we're throwing the pennies in front of the steamroller, and we're driving it, where everybody else is trying to pick up those pennies. That's funny. Paradoxology. So convexity pricing is quite less than the previous rule to price your fly at or about 10% of your spread with, or am I missing something important? Well, the 10% rule will get you closer to convexity pricing. And the reason why they used to trade that on the American exchange is that they found it a really good compromise between the risk that they take and then the profits that they make. Allowed them to stay in the trades, and then they could size well. But you're right, it doesn't give you the optimal price. The optimal price is a little further out. It's typically out around 1 to 24 or even further out, 1 to 30, not 1 to 9 or 1 to 10. So that is very true. Any more questions? If there are, I'll answer them. If there aren't, then the presentation, I think, is coming to an end. So these are all great questions. Thank you very much. So let's wrap this up. How we get into a 0 DTE trade. First of all, we do most of the work before we ever take the trade. We already know how wide we're going to do it, what direction we're going in, where the entry points are going to be. It could be one of many entry points. And now all we have to do, and we already know when we do put that trade in, how much we're going to pay for it, approximately. So we know all this stuff right up front. And now all we're doing is waiting for the entry event to occur. And when it does, and we're confident on it, we execute the trade. Once we're in, we then start mapping out the possible scenarios that could happen. And that will give us a leg up on how we're going to manage that trade. So again, we're doing the same thing. Prior to the trade, we already know everything about getting into the trade. Once in the trade, we map out everything that it will take to get out of the trade with a maximum profit. So we'll talk about that in more detail because that's a very interesting topic. Any trades for the next few minutes? You know, I haven't looked, Diego, but maybe we can do that. We need to go to Trading View. So what Diego is referring to is a gamma scalping trade. I wouldn't be putting on a 0 DTE trade right here. You've lost a lot of your edge. There's been a lot of premium decay. But here we are. There's only 10 minutes left to go. This is going to be tough, but you never know. So let's take a look at where the market is. Oh, it's dropping hard. Yeah. I would say a small trade right here on this structural level. This is the bottom of a node, but it hasn't come anywhere close to this structural level here, and it's still got a long ways to go. And we're running out of time. We could put on a very, very cheap trade right in this area here, right below it, and I think we might get a little bit of a retrace back into it. So let's see what we can do. So maybe a 10 wide SPX trade. That's kind of expensive for me. I'd want it to be much cheaper than that, so we have to put it out of the money a little bit. See, this is the part that I'm talking about slow, the fact that I have to manipulate everything. I'm trying to get ahead of it and go further up. Oh, that went to 0. All right, let's go a little closer. Wow. You see the difference there? That's convexity. I went one strike down, it's $1.50. I went one strike up and it went to 0. That's crazy. Yeah, I would say if you're going to put a trade on, that's probably it right there. Oh, it just popped up to 70.55 cents. It's going crazy. Yeah, it's too late. And we didn't really do any setup here, so I wouldn't be taking this trade, Diego. Oh, I wasn't even showing my Thinkorswim. I was showing TradingView. Yeah, so here I have a 10 wide trade. Market is, can't tell where the market is. Looks like it's right about here. Yep, right there. So that's pretty expensive for a 10 wide trade on a trade like this. I don't want to pay anywhere near 10%, right? This is about 6%. I'd rather trade, less than 5% of the trade. And the other problem is I'm not backstopped by any structural level. So if we go to market structure, so there's structure right there. Had we moved all the way down to there, then I think putting on that trade very close. But with 6 minutes left, that's a tough one. And it looks like the market's dying. It's just stopping. Huh. All right. Let's go back to the big head and we'll wrap this up. Yeah. So Diego, just so you know, the gamma scalp trade, like what I was looking for, sets up nice and clean about 1 out of every 10, 15 trading days. And today just wasn't one of them. You know, if I saw a setup that occurred maybe starting around 3:15, then I can start getting prepared for it and get all my strategy set up. I've got a nice structural level. I can squeeze that structural level with a fly, and then I wait for that event to happen, and then get into it. But not today. Mark says, arrive late. Can I rewatch on your YouTube page? Yes, you can. So right after this is over, it should be ready for viewing. All right. Well, I want to thank everybody very much. You're helping make this a successful show. In the future, we're going to be doing trading here right online. We'll look at some of these Gamma Scalp trades. They don't come across too often. I will also go over my own personal trades and show you how I actually set them up and manage the profits. Future episodes, we'll be talking about a wide range of topics. Every day will be something new and impactful. All right. I want to thank everybody very much for showing up. Really appreciate it. There is I have keys that I'm doing things. I know that's the countdown. And is it this one? No. It's that. Okay. All right. Thank you all. Coach Ernie, out.